Hey there, everyone. Welcome to my channel. My name is Ryan Schul. This channel is all about data science, machine learning, deep learning, artificial intelligence, and things such as this. And let me preference the lesson today, which is going to be about calculating financial ratios. Let me just preface it by saying that I'm trying to use this medium here to generate income and as a means of sustaining myself and generating some cash flow and being able to pay my bills. I'm trying to make this into a successful career at this point. The job market is pretty much dead. It's flatlined, and I think YouTube is an excellent channel for communication and for sharing knowledge and dropping information to people literally all over the world to communicate with millions of people. So I'm going to focus on this for a while. I do have to get my metrics up. I do need more subscribers. I do need more people watching more hours. YouTube requires about, I think, 3,000 hours of videos watched and 500 subs. So a sub is short for subscriber. I have the 500 subs. I don't have the 3,000 hours. So hopefully after a few more videos, maybe a couple dozen, maybe another 100, who knows, hopefully I'll have that 3,000 and I can start making money. So that is it's my spiel here. It's my intro. So yeah, so this one is all about financial ratios. There's a whole bunch of them, okay? There's probably at least 40, 50 that are pretty common. There's probably 25 to 35 that are fairly common. There's probably about 70 to 80 that are somewhat used. Some of them are not necessarily ratios per se, financial ratios, but maybe other financial metrics that help you understand the financial, let's say the financial health of the company, right? So there's all kinds of different things, and it's a little bit arbitrary, but I mean, it's pretty well-defined kind of area too. So let me take you through it and show you how it works. But again, keep an open mind. Some of these things are a little bit open to interpretation, and they are a little bit flexible and a little bit arbitrary, but there are some pretty well-defined rules in place here. So let me show it to you. Basically, analyzing corporate financial statements helps us to understand the health of the business, the overall confidence of investors, analysts, other stakeholders can assess the financial health, performance, and viability of a company. Why do we do this? There's a bunch of reasons to evaluate profitability. Is this going to be a good long-term investment, maybe short-term investment, maybe mid-term investment, but is this worth us putting our money into this company and investing in this enterprise, yes or no, right? So when we look at the financial ratios, I'm going to take you through it in just a minute. We can make these kind of determinations, right? And make a confident assessment about the quality or the sustainability or the overall health of the company, right? So we're looking at profit margins, things like return on equity, ROA, which is return on assets. I'll show you how to do that in just a moment. We also assess liquidity, so how capable is a company of paying its bills? If you have APs or accounts payable, can you pay your bills? If you have ARs, which is accounts receivable, can you go out and fetch that money and claim it and take it back for your business? Because you need that to continue your operations. You need continued cash flows to operate the business, right? We'll look at current ratios, cash flow ratios, debt to equity ratios. Okay, if a company has a lot of debt, it's going to take a lot of interest payments on those bonds. Every month, the company has to have very sustainable, predictable, and repeatable cash flows to be able to pay those interest payments on the bonds, right? So it's a little bit more leverage, definitely more leverage. It's a little bit more responsibility for the company to make consistent, persistent cash flows, because if you don't, the bond payers are going to come knock on your door and demand that the company be liquidated, okay? And the bond payers, the bond owners of the corporation get paid first, right? Before the equity holders. The equity holders easily could get nothing. You saw that in several liquidations, Bear Stearns, Lehman Brothers, WorldCom, Enron, take your pick, right? There's so many of them. So equity holders get paid last and bond holders get paid first. So there's definitely a priority if the company is being liquidated, and who, in terms of who receives what. We'll look at interest coverage ratios, measure overall operating efficiencies, asset turnover, measures the efficiency of how a company uses its assets to generate revenue. Inventory turnover is how quickly does a company turn over its inventory. Does it sit in a warehouse for a long time, or does it sell the inventory very quickly? So you want the inventory on the shelves and getting sold pretty quickly, and probably the quicker the better. But if the shelves get emptied out and everything gets bought, right, and nothing gets replenished, then you have a whole nother issue. You have a supply chain issue too, right? So it's definitely a balancing act. You're kind of on a high wire, tightrope, or whatever you want to call it, and you're balancing yourself in all these different facets of the business. It's very, very interesting, and it's a lot of moving parts. It's kind of confusing, but let me show you how these things work in a big picture and try to not desensitize, not deconfuse, unconfuse, or like just shine a light on what's going on here and make all this stuff less convoluted, less overwhelming, less confusing. Okay, that's the point here. So there's a few more things. I'm not going to go through every single one here, but I have my notes. I'm going to share all this code with you when I post the video later today, so you'll have access to all the notes here, all the comparative analysis, forecasting, credit, loan, risk assessment, investor confidence, so on and so forth. Okay, I'm going to give you all this. Let's just pause for one moment and take a look at this website, which is one of my personal favorites. It's called finviz.com. Okay, you can go over here and look for a whole bunch of different companies. I don't think I've ever searched for one and not found it. I don't know how many different companies they track, but it probably says somewhere on their website. Maybe we can even Google it. Finviz. I bet it's 50,000. How many companies? Own, support, offer, have. Just say have, I guess. I don't know what to call it. Finviz have. Let's see. Okay. Come on, Google. Dr. Google, Mr. Google. What's this thing called? Thousands. Okay, thousands. It just says thousands. That's fine. Thousands is fine. I've never actually searched for a company and not found what I was looking for. It has all the big ones, right? You can see some of the tickers here. Mass, Frigate, JFIN. I don't even know some of these. Golf. But it is fairly comprehensive, and of course they're going to have all of the Dow components, the S&P 500, probably Russell 2000, probably Wilshire 5000, probably all those, right? I like this thing over here on the right. You can see sort of like what's going on in the market here, what's up and what's down, and what's trading based on the movement, right? So this is called a tree map here. A bigger square or a bigger rectangle indicates a bigger move, right? And the darker the color, the bigger the move too, right? I think that's how you interpret it. And green is up, right? So green is good, red is down. And then, of course, if you click on each one, you can see the details of that. So here's NVIDIA. Oh, yeah, here they go. So here's the S&P 500. So this is pretty interesting. We're getting a little off topic, but you know what? This is pretty interesting. It's probably worth a couple minutes of time. So there's, okay, so Ireland, United Kingdom, this is Europe, Netherlands, and all at least the top 10 right there, top 20. This is China, Alibaba, Japan. I don't know any of these. Oh, MUFG, I know that, and Sony. Taiwan, they've got a couple. So Canada and Cayman Islands, and then S&P 500. Here's the S&P. Yeah, so that's it. So, yeah, this is a little bit off track from what I was planning, but you know what? We can go through a couple of these things. We have the SOC screener, Google Maps, Google Groups. Some of these things I'm just seeing for the first time. I don't use this all the time. Oh yeah, we just saw that one. Portfolio, insider ownership. This is not insider trading. That's illegal, but insiders can be. Oh no, they don't even show it because I don't subscribe to this. Futures and forex, but insiders are company executives that can own certain shares, right? So the CEO can certainly own a bunch of shares, CFO, CRO, CTO, things like that. So they're going to own a small percent. If you see these insiders doing buys and sells, it's probably an indicative sign, if they're buying, that they have faith and confidence that the stock is going up. And if they're selling, you probably want to get out. If you see a corporate insider selling a bunch of stock, you probably want to get out pretty quick because they're pretty close to the business and they probably know something you don't know. And if they're selling millions of shares, you should hop to it and probably do the same thing, right? Because that's probably not a good sign. Okay. So anyways, let's look for one stock, AAPL. I like Apple. I like Microsoft better, but Apple is pretty nice too. And let's just take a quick look. This is really the point of the video here, to look at these financial ratios and these metrics down here. So you have index, market cap, income. This is the income, net income, This is sales for the business, 395 billion in sales. B is a billion. If you see an M, that's million, right? That should be pretty intuitive. Dividends, estimated dividends, TTM is trailing 12 months. And if you put the mouse over, it has a bubble that pops up and it shows you more details. So February 10th, 2025 is the ex-dividend date. That is, if my memory serves me, the day that the stock trades without a dividend. You would have to buy the stock the day before if you expect to get the dividend payout. If you buy it the day after, the stock actually drops by the amount of the dividend, right? Because that's paid out to shareholders and you're going to miss it if you buy it the day before you get that dividend, right? So the stock will drop just a little tiny bit to account for the change in value for paying the dividend. So here you have the price to earnings, forward price to earnings. So that's looking into the future. So this actually looks like it's kind of on a downtrend. So Apple might be slowing down in terms of its sales or its research and development or something. This is price to earnings growth. So P to E divided by the growth. So the PEG ratio is very interesting. Price to sales, price to book. This is the price to book right here, price to book value. So this is the price of the stock divided by the book value of the stock. And it's all relative, so it's divided by the number of shares. So if you see price to book, it's the book value divided by the number of shares, the price of stock divided by the number of shares, right? You have to make a relative comparison and really look at apples to apples, right? This has to be an apples to apples comparison or it's meaningless, right? So if it has to be converted by the number of shares, you have to divide by the number of shares. Like earnings per shares is a classic example. This is the total earnings and net income of the company divided by the number of shares outstanding. So where do we get the shares? If we go down here, I think we can look for it. Shares outstanding. Yep, right there. So 15,000, 040, 15,000. So I think this is in thousands now. If I go over here, I'll also have this screen. I like this. I like Yahoo Finance. They have the income statement, the balance sheet, and the cash flow statement. So I'm a huge fan of this. I use this all the time. All right, so you have the big three: income statement, balance sheet, cash flow. And then if you go back here to the FinViz, you should see almost exactly the same. So here's the income statement. Yep, balance sheet right there and cash flow statement. So the way that these financial ratios work is that sometimes the ratio comes just from the financial statement, sometimes just from the income statement, just from the balance sheet, or just from the cash flow statement. But sometimes you need 2 or even 3 different statements. You'll have to get all 3 of these statements to actually do the financial ratio calculation. So let's look at a couple examples, just the old school way of doing it, and then I'll show you a very fast automated solution. That's the point of this video, right? To automate this task. So we have net income. This is Apple. Net income is 96,150. So if I go to the income statement and scroll down a little bit here, so income statement, and this loads up. Okay, we also have an ad. Let me get rid of that. So we have the total revenue. Okay, that's everything before the cost of doing business. So the COGS is basically cost for everything to run the business, right? So you're paying your employees their salaries, things like electricity for the building, heat, hot water, rent, things like that. That's a cost of goods sold. That's a cost of doing business. If you don't have a cost of goods sold, you can have a huge profit. But who among us has just pure profit, right? There's always a cost to doing business in something, right? So you subtract out your COGS and you have your gross profit. Subtract out your selling, general, and administrative expenses. I'm sorry, I think I said like salaries come into the COGS. The COGS is like the raw materials, right, to produce the product. Or if you're a service company, the raw materials for the service, that might be salaries, right? If you're making tables or chairs or some kind of furniture, then that's the cost to manufacture the product that you're selling, right? Gross profit. SG&A is more like the salaries for the employees, heat and hot water, electricity, things like that. R&D gets subtracted out. Other operating expenses. Then you have your operating income. Any interest expense, if you have debt outstanding, like I explained before, you could have an unusual expense. That could be a catastrophe, damage to a warehouse, an unusual event, insurance, or you don't have insurance maybe, and you have to pay for restoration of the damaged part of your business, whatever that is. Like net income before taxes, income taxes, and then consolidated net income, and then net income. So we finally get down to net income, right? So 36,330, and this is for the last 12 months of 2024, right? We're just at the beginning of March here. 2025. So I think they're going to come out with a new statement really soon. That's going to be, at the end of March, right? So you have January, February, March. So we have about another month, and then we'll see that update. Okay, but let's go back and look at the financial ratio. I don't want to get off track too much here. So we have the net income 96,150. So if we go back here, and this doesn't look like Apple. Let me go back. I think I picked a different company, APL. Okay, Apple. Okay, go down to the income statement, and it's right down here towards the bottom. Okay, income statement and the income. 36,330. Okay, so net income is 36,330, and we do have Apple here. Okay, so let me update that. 36,330. Wait, 36. Yeah, 330. 36,330. Okay, and let me get rid of that. And then we have shares outstanding. So how many shares does the company have? Sorry, let me get rid of this ad. It's very annoying there. Shares outstanding. There's another one, 15,040. Okay, let me enter that, 15,040. Shares outstanding, and the EPS should be the net income divided by the shares outstanding. This is earnings per share. Okay, so the real earnings of the firm after the COGS, SG&A, all your unusual expenses, right? If there's damage to a warehouse or a company vehicle and you have to get that replaced or repaired or something like that. So 36,330 is the net income. Oops, and I have another ad popping up, 33360. But that is for the last quarter. I think they are taking the annual number. Let me look at this real quick. I think they're using the annual number here. That would be the normal way of doing it. So net income 96,150. Okay, you say it 96,150. Okay, so let's go back here. Sorry about that. 96,96150. Okay, and the shares outstanding 15,040. You can see that number down here. So the EPS is earnings per share. So this is the entire annual earning, 12 months of earnings, and the number of shares outstanding. EPS, let me look at this. I'm looking at TTM 6.29, and we calculated 6.39 EPS, 6.39. 6.29 and a half, 6.29. Oh, there might be a special way of deriving this number divided by that. Let's just see what the percentage off. It's off by 1%, 1.6%. So why would it be off 1.6%? I'm not sure exactly how this is being calculated. 6.29 versus 6.39. Scroll to statement 15,040, and you have 96,150. And that is the TTM number. So there might be a small adjustment. Like I said at the beginning of the video, these things are pretty well defined, and it should be pretty mature way of doing these calculations. But there could be small exceptions, small modifications, small changes, or alterations to the way these numbers are calculated. So they are reporting 6.29. We're getting 6.39. And I don't know why we're off 1.6%, but there should be some kind of documentation, I think, about how this number is derived. And it might take like a weighted average, because we're 4 days into March, and there's probably like another, in terms of business days, probably another 18 to 19 business days left for the month of March. So they might be doing some kind of weighting of the number or something like that. Like, it's pretty close. Okay, so we pretty much got the earnings per share, and that is net income divided by number of shares outstanding, but it is off by a little bit. Okay, so I'm not sure if they have some documentation how that number is calculated or not, but we got pretty close. So let's look at another example. So earnings per share 6.29, 6.39. Oh yeah, that's right. Okay, and let's look at the price to earnings. Okay, so the stock price. Let's see, the stock price yesterday was previous close 238.03. So I have that over here, 283.03, right? And earnings per share 6.29. That's what they recorded. I calculated 6.39, but the price of earnings should be the previous stock price close. That's the cost of the stock if you buy it today in the market, $238. Earnings per share $6.29. So the price per share, so the price of the stock divided by the earnings of the stock is 37.84. If we go look for PE, we can quickly do a search, P divided by E, and PE is 38.03, okay, 38.03, and we're getting 37.84, 38.03. Let's look at the difference, equals that divided by that. That's the relative difference, 99%. It's off by 1/2 of 1%. So again, these guys might have like a special convention for calculating the P to E. Maybe they're getting the current stock price. The stock price might be down a little bit today. If I go look at Apple, what did they say over here? 238.18. So the stock price might have depreciated a little bit. 238.08 is pretty much the same. So it was off by 0.5%. I'm not sure why. If FinViz has some documentation, we can look into it. This is a convention for doing this. The stock price divided by the earnings per share. So that's the price to earnings. So again, pretty close, not exactly there. So there might be a small adjustment or alteration. I'm not sure. Let's again look at the net income and the total assets. So go back here. The net income, remember, is down at the bottom. If you click this, it takes you to it. So income, net income, 96150, and this is in thousands, I'm sure. If we go over here, 96150, yep, I got that. And then total assets, 344085. So for that, we have to go to the balance sheet, right? Total assets. Let's make sure we get everything, not the current assets. The current assets are everything that's being used this current quarter. Long-term assets are long-term, right? They're used over multiple quarters or multiple periods. This current asset is used over the current period, right? So the current 12 months. We want total assets is 364980. Is that it? Total assets, I think. That's going to include long-term and short-term, 364980. So let me copy that, put that over here. Okay, and that, let me change the formatting. Let me drag down, fill the format. So we can see it. It's a white, I guess, because it comes white off the screen. So the format looks a little bit off. Okay, so we have ROA 26.34. So let's go up and see what they say for the ROA. I can do a Control F to look for this guy. ROA. So here it is, 27.57. So again, it's off by a tad. 27.57, that's what they said, right? And we're calculating net income over total assets as a return on assets. Let's look what the difference is. That divided by that gives you the relative change, right? 0.96. So this is off a little bit. This is off about 4%. This is off 4% now. So that is a little bit more concerning. 96% accurate, 4% differential. So how are they getting that ROA? So net income TTM, maybe they're defining income, giving them more of a weight to the income. Let me look here. TTM, income, net income, 96150. So that is 150. And that's what I have there. Okay, so yeah, so it's another mystery. Okay, so we have three that are pretty close. Neither one jives exactly. So you could see this is kind of an art and a science, both, right? It's not really like as precise as you might expect it to be, but it's not very arbitrary either. There are definitions and there's requirements on how to do these things, right? But again, I think this specific resource, FinViz, is doing things a little bit different and adding in some customization that I'm not aware of. I don't see any kind of documentation or explanation of how they're getting these numbers. So we are close, but things are a little bit off. So is that a major concern? No, that is not. It's pretty close. And when you're doing financial metrics, pretty close is usually good enough. I mean, you can debate this ad nauseum, but is it going to benefit you? Probably not, right? So we have some financial ratios. You can see it's a little bit laborious. It takes labor, it takes time, it takes effort to get these things done. So there's a few ways you could do it. You can go to download these financial statements. I actually started to do this, and even when I wrote the Python code, it was kind of laborious and time-consuming, and it took a lot of effort. And basically, sometimes I get a little bit lazy, so I gave up pretty quick because I figured out there's a better way to do this. But you can actually go to the income statement. You can expand this button right here, hit it once and it will collapse it again, expand. So there's a collapse view, or that's the expanded view, and then you can do it like step by step. If you get this thing over here, it gets everything all at once, right? So that is the collapse view, that is the expanded view, and you have this for all of these three financial statements, right? The income statement, balance sheet, cash flow. So you can control the view over here and expand all these things. So that's great. So you can go ahead and calculate all of these numbers from here, right? And if you go back to here, income statement, and look at the net income trailing 12 months, this should be the same. Like you can't really change these net income numbers. Where is it? Total expenses, net income, interest expense. Where's my net income here? EBITDA. Oh, here, it's up a little bit. Okay. Oh, here's the EPS, right? So they're calculating EPS. They got 6.33. We got 6.39. So even that's different, right? 6.39 over here. EPS, right? EPS. Give me that one. EPS 6.29. They're getting 6.29, and these guys have 6.33, right? So even that is different. And where was my net income? 96,150 billion, right? Because these are in millions. If you look, I'm sorry, this is in thousands. So you take this 96,150 and multiply by 1,000, right, to get this. Equal that times 100. So it's actually 96 billion in net income. And that number does jive with this net income over here. And that does jive with this. So the number of shares outstanding has to be different. The way that FinViz is calculating shares outstanding has to be different. If I Google this, now I'm curious about this. Shares outstanding, Apple, shares outstanding, APL. They go here, 115, 181. Maybe they're rounding. That could be another thing. It could be a rounding issue. So that's another thing to consider. If I go over here to shares outstanding, 15,473. And let me get this just a little bit easier to read. And put the format on there. Format, fill format only, 1501. So you can see the shares outstanding is different, right? If you divide that equals that by that, that is your EPS, 6.37, and Apple says 6.33, and these guys say 6.29. Okay, so it depends which source you go to. They're all a little different, but they're all comprehensively somewhat similar. Okay, so that's what we'd expect. If these numbers were magnitudes different, like 1 or 2 times different, I would be very concerned about that. If it's off by 1%, it's not a big concern. Something wasn't updated, or more likely it's a rounding issue, right? They're not getting all of the details that we're getting over here. So maybe they're cutting out at 15,181. Maybe they chopped off that 724. Maybe they rounded that. 720. Oh wait, 0, because I'm chopping that off. And then they could be doing something like that. So it's a rounding or slight tweak to the calculation or modification to enhance the way that these guys do their analysis. Again, like there's rules that govern this, but it doesn't absolutely have to be done like a very, very specialized way. And the numbers can be massaged a little bit, right, for a variety of purposes. Maybe they think Apple shares can be diluted, and you see some evidence over there. You have diluted EPS, right, if some of the shares outstanding I think can be bought back. What is diluted EPS? They could be adjusting for that. The FinViz guys could be adjusted for that. Diluted EPS. Diluted EPS is a financial metric that estimates how much a profit company makes per share of common stock. It's a more comprehensive measure of company's profitability. Subtract any preferred stock. Oh yeah, it's based on preferred stock. I remember that now. So you would subtract out the preferred stock, and you would have like a slightly adjusted diluted EPS is going to be slightly less, right? So 6.33 would be the best estimate if you subtract out the preferred stock, which is a very small percentage of overall stock. Most people have common stock. You can have preferred. I think it pays a slightly higher dividend, and there's rules that govern how that can be bought and sold. It's not as easy to buy and sell as common stock, right? So these guys are probably subtracting out preferred stock, and maybe, again, it's just a rounding error. So that 6.29 is pretty close to the 6.30. So let's just go with that. But the whole point of this exercise is it's time consuming, it's labor intensive, it takes effort to do these financial ratios and all these calculations. Then when you get one done, we only had 3, right? 30 minutes into the video, I apologize for this right now. We only have 3 financial metrics done. We have the EPS, the price to earnings, and the return on assets, the ROA. But I promise you, this is going to pay off huge, okay? So rather than doing this whole comprehensive, very time-consuming, prone to error, you can see it's very easy to make a mistake, and then your financial ratio is totally messed up, and it doesn't even match what Yahoo Finance has or FinViz or another resource. You can go to a major bank, probably Morgan Stanley, JP Morgan, and they're going to calculate just slightly differently. And then you'll have like a 3rd or 4th or 5th version of financial metrics, right? But one easy way to do an apples to apples comparison with everything, including all of the financial metrics of one company and then the overall health or the financial health of the company, is to import the data from FinViz. So I put together this script. So again, apologize for the preamble here, but it's just a big setup to go ahead and import this information here. And you can see it takes a lot of effort to get this done, right? If we go ahead and import the data just based on these ticker symbols, we're going to go to that Financial Viz website. I added in a slight delay over here, so the computer actually sleeps for about 2 seconds, because if you make too many requests in a rapid fire fashion, the website actually detects that you're a robot logging in, and that's exactly what this is, right? This is a bot making all these requests because it's too fast for a human being to do this, right? So if you make all these requests and it's like boom, 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 and you grab 30 tickers, or I think there's 29 in this, whatever, 20 or 30. If it's too fast, the website is going to shut you down and just say, hey, you can't do that, okay? So we add in a little timer to go ahead and pause in between requests that are being made. But after we make that adjustment here, we can get all of the tickers screen scraped from that website, and then we can work with everything. So it's going through 30 different tickers and capturing all this information for you, okay? So very nice, very fast, very efficient way to get all the details from all these stocks and get all the financial metrics so you don't have to do it yourself. Now, again, remember, this could be slightly different. 6.29, not exactly the same thing, 6.30, but for all intents and purposes, it's pretty close, okay? So if you want to save yourself a lot of headache, just use this methodology, go screen scrape the data, and you're going to have what you need in a few moments here. So everything is imported now. Here's a view of the data frame. I'm doing display DF tail. So you have index, price to earnings. If you look at one MCD, we see 27.13 and EPS 11.39. Let's look at McDonald's, MCD, CD, just quick, and then I'll wrap it up, okay? This video does not have to drag on. Okay, so MCD, we're just looking at the first one for peace of mind, okay? Quick sanity check. MCD, PE, let's look at the PE. PE, find it P-E, price to earnings. Whoops, I forgot the hash, not the hash, that's dividing sign. PE, 27.21. Is that what we have? 27.13. Okay, it's off by a bit. They might have some old data stuck in there. EPS 11.39. EPS, where's my EPS? 11.39. Okay, so that one is updated. There might be something in the way the data is pulled that's kind of jammed up, or something didn't refresh, because I would expect that to be pretty much spot on. Wait, why does it keep saying wait? Could be a problem with the browser, and this thing keeps spinning too. So I think the data quality is intact. I think that's totally fine. I think maybe the browser gets jammed up, and you can see it's still spinning. Well, just up. So sometimes you have to clear the cache in your browser. Let's look at one more MSFT, Microsoft. So let's go over here, MSFT. So that's another thing. If you do have some weirdness or some issues here, clear your browser's cache before you run that screen scraper job. Okay, so MSFT, let me look at PE 31.04. Okay, where's my PE at? PE 30.98. So again, I think something's jammed up in the browser memory. We're getting most of it, or something isn't refreshing, because this little window, this little wheel here keeps spinning. So I think that could be a little bit weird. Let's look at the EPS, 12.42. Okay, here's my search EPS, 12.42. And that's exactly what we would expect, trailing 12 months. I think it's a browser caching issue, so it's off by a tad. We're not going to worry about that, okay? The thing I really want to show you is right here, how to clean up these metrics. We're going to look for these top 15, okay? This lesson that I'm teaching now is called calculating the top 15 common financial ratios, okay? And again, there's a very time-consuming way to do that, like I showed you here, using Excel to go ahead and copy and paste everything and do it yourself, or to use the screen scraper that I showed you over here. The screen scraper is going to be magnitudes times faster, right? And it's going to do the fetch of all the data in a couple of moments and bring everything back, clean it up right here. We are going to apply a small data cleanup to convert the ROA to a number. So if you look over here, ROA, we have this, I think if we go over here, ROA, this will come in as 15%. If you look at the original data here, ROA, and I look for that, usually they have percent signs, right? Or they have a decimal place or something. Yeah, here's this percent sign. So 18.47 is ROA. We want to get rid of that percent sign because that's going to cause problems. So you really want just pure numbers when you're working with these things. You don't want percent signs. You want B for billion, M for million. Here's an example over here. This has to be stripped off. This B has to be stripped. That B has to be stripped. Okay, we want numbers only. But if you strip off a billion, you can just multiply that by a factor of, I think, whatever converts that into billions. That looks probably like 100,000 or 1 million, and then 100,000 if it's a million factor, right? So we just want to be able to handle the non-numeric items. So anything with a percent sign, that's why I'm cleaning up the ROA. We get rid of the percent sign. So Microsoft here, I think, was 18%. If you go over to the side, ROA is 18, and Microsoft is this fourth row right here. And you go over here, 18%. So it's kind of cleaning up a little bit of the fraction too. That's okay. We're losing a little precision, but that's okay for our purposes. So we want to go ahead and set up sort of a threshold for performance and say if the PE is above or below or within this range, it could be better or worse, or it could be okay for the company. So we want to look at the relative scale of the PE, the EPS, forward PE, price to earnings growth, price to sales, price to book, price to free cash flow. Beta is the sensitivity of the stock. The higher the beta, the more sensitive the stock is to moves in the overall stock market. If it's 2, it's going to move twice as much as the market. If it's 1/2, it moves half as much as the market moves, right? So the beta is the sensitivity. Quick ratio, RSI is relative strength index. So that is sort of a trend or a moving average. It moves over time, right? And it can be a support or resistance level, resistance on the way up, support on the way down. The stock price tends to not go above the resistance level and below the support level. Debt to equity, another financial metric, long-term debt to equity, ROA, ROE, and sales year-over-year trailing 12 months. So these are 15 that I picked. I think these are some of the 50 most common. People can argue there could be 15 stocks that are common. So if you want to add to this list, just go ahead and add any metric that you want. So look over here. Anything that's interesting, you can just add that in. ROI, if you want to add ROI, look at ROI. Do a quick Google search to understand what is the range or upper, middle, and lower threshold for the ROI, and you can add that in right here, right? So ROI, put this in quotes because it's text, ROI, and then this is a dictionary. So you'd have a key. This is a key for the dictionary, okay? Key and the value. These would be the values, and then 5, comma, 10, comma, 20. I don't know what that is. I researched these others, so I know that. But I'm just saying, if you want to add in more metrics, I have 15 if you want to add in 10 more to get 25, another 15 to get 30. By all means, go ahead and do that. I think this is a great start right here. And when you go ahead and run this, you can add to the dictionary, like I just explained. When you go ahead and run this, you're going to get updates for all of the health elements or health factors of all these financial ratios for the whole company. It will get a score for the whole company from 0 to 10, and then a score for each of these financial ratios. So this is pretty cool. I came up with the idea yesterday, put some code together and tested it, and it worked pretty well. So again, we have the screen scraper up here. You don't have to change anything other than you might want to change the ticker symbols that you put in. You can put in whatever you want. That's very, very dynamic. You go ahead and fetch the data, do the cleanup in this cell right here. These are called cells in Jupyter Notebook. And then we will measure the health of each metric right here. And you can see for UNH, we have a PE of 30.66. Okay, this should be the first one, I think. I don't see UNH. Let's go back here. That's fine. Oh, did I get the tail of that or the head of that? Oh, tail, yeah. If I did the head, okay, then UNH should come up first, right? Let me make a little change here. Sorry, guys. Okay, and then UNH 30.66. So that's the PE, okay? So this is how this works. You look at the PE 30.66, and how does that score relative to the PEs of all the companies in the whole universe? This gets a score of 5. So closer to 10 is better. 5 is in between, it's middle. EPS trailing 12 months, so it's a very strong EPS that gets a score of 10. 15.54, if I go up here, where's my EPS? 15.54 right there. Okay, so relative to all the other businesses, including the sector and the industry that you operate in, because that's important too. Some businesses can have very different financial ratios from other businesses just depending on the sector, right? Like how you use your capital can be very different for manufacturing versus a service company like consulting, right? Or like a transportation company like UPS or something like that. How Amazon uses its resources can be completely different from how Volkswagen uses its financial resources, right? So you have to compare the industry and the sector and the company relative to other companies in industry and sector. And that's how we're getting these scores over here, okay? So forward PE, I'm getting 14.22 for UNH. Let's go back here, forward PE, and I got 14.22. So that looks good, but how is it compared to its peer group in the sector and in the industry that it operates in? It's actually low. It scores 0, right? So what we're going to do is take a score of all these. 10 is great. 0 is pretty horrible. But we compare all of these and create a relative score for this company. So UNH gets a relative score of 4.54. 10 is the best. 0 is the worst. CRM, this I think is Salesforce, I think is CRM. And they get 44.51. So a score of 10 for the PE. If we go over here, I think that's the second one, 44.51. So it's PE. Gets a score of 10. So hopefully that makes sense. You're looking at every company in the industry and the sector, comparing it to the peer group, right? Because depending on which industry and sector you operate in, that's going to make a difference what your financial ratios are. Because a great financial ratio could look horrible in a different sector and vice versa. Something that looks horrible in one sector could look fantastic in another sector, right? So it's relative to those. That's what we're doing here. We're evaluating each financial metric, quick and easy way, without having to do all of this Excel stuff over here, right? That is going to drive you nuts very quickly. If you can automate the whole process and do it and eliminate all these pain points, by all means, then do that, right? There's no reason not to do this. Okay, hopefully I illustrated that point. So you have all the scores for all the financial metrics, and you have a whole comprehensive score for the entire company. This gets 5 out of 10. VZ, I think that is Verizon, 3 out of 10. So they have some trouble. 5.41 for V. I think this is Visa credit card. Okay, so we get all the in-between intermediate scores for all of these financial metrics. Then we get a score for the overall company. That's what I get here. So the total score, Apple rates the best, 6.67, relative to the 15 metrics, financial metrics we just looked at. KO, I think, is Coca-Cola. This is McDonald's. These are the top 3. And let me prove it to you. If you have any doubt, even at this point, hopefully you suck through. Congratulations. If you made it through 45 minutes of the video, I honestly thought it'd be more like 10 or 15. So I will try to finish it up soon. Let me just prove one more point here. If we go back to Apple and look at the stock price over time relative to the financial health of the company. So we're saying this is 6.67, kind of close to 10. This is the best rated in the entire list here. So CVX is the worst. Apple is the best. Let's look at the stock price. So does the financial metric match the stock price? And this is going back, let's say, monthly basis. You can change all these charts here, monthly, weekly, daily. And if we go back like 1 year, usually these are year to year. This is going back a few years now, right? But if I move this, I think if I go over to the side, that doesn't matter. You know, if we go back here, this is the current on the right-hand side. So 2025 or early into 2025, we go back about a year or so. That is the past year from this little crosshair point right here to the end. And Apple is way up, right? So the company is very healthy. We got a score of 6.67 and the stock price is up. Let's look at the same for KO. This, I believe, is Coca-Cola, KO. I just want to see if the stock metric that we're calculating matches up with the stock price, or the financial metric that we're creating from all the financial metrics, right? From all the financial ratios, we have a comprehensive company ratio. So 6.67, that was the best. This is next best, KO. Let's look at KO for the past year. And the stock is up, right? So again, from 2004, 2005. If you go back 2-3 years, it's all nothing but up, right? So this is a good investment. KO, Apple, MCD. This is up 6.1 on MCD. This will be the last one, and I'll wrap it up, I promise. MCD, and the stock is, I lost it. What happened there? MCD. Stock is up for the past year. Come on, where's my MCD? Show me my MCD. And the stock is up for the past year. So these are the best stocks. If you want to look at the worst right here is CVX. CVX, I'm not sure what that is. Let me see. Chevron. Okay, so oil company. CVX, let's see what the stock looks like in the past year. I'm guessing down. And we are seeing kind of sideways. Let me see. Kind of sideways, trending down, I think, for the past year. Ooh, just kind of flat for the last year. Okay, so anyways, these are the best companies. These are the worst. So I'm going to share that with you with all my notes. Here's all the financial ratios broken down with definitions and the meaning and the purpose of each ratio too. So I'm going to save that for you guys and post that with the video, and I'll do that later today, and I'll see you guys in the next video. Okay, talk to you soon. Bye.